We never really think about electricity until there's a power cut. And we never really think about energy security until something blows up globally. That's kind of what's been happening right now. And it has made a lot of people, including a lot of investors, suddenly sit up and pay attention to the power sector. So today we're going to walk through the entire Indian power sector: generation, transmission, construction, financing, distribution, renewables, the full picture layer by layer. And we are going to do it the way an investor should think about it. Which companies sit where, what are they actually doing, and where is the real opportunity? So stay with me till the end. But let's start with something that puts the whole power story in perspective. India imports close to 90% of its crude oil. Nearly half of its natural gas and even coal, which we have plenty of domestically, still has import gaps. So a country of 1.4 billion people growing fast is deeply dependent on other countries for the fuel that keeps everything running. Now, coal still dominates our power generation, roughly 75% of it. Renewables are growing fast, but in pure volume terms, they are still catching up. So, India is in this interesting middle ground right now, pushing hard for clean energy while still needing thermal power to keep the grid stable every single day. But here's that one number that genuinely surprised me. Electricity is the one exception to all this import dependence. India's electricity import dependence is actually negative. It is minus 0.15%. We are a net exporter. Small number today, but as generation capacity keeps rising, that export story is only going to get bigger. And for investors, all the companies building this capacity across every layer are worth understanding properly. So let's go through it one layer at a time. Let's start with the first layer, that's electricity generation. Everything starts here. Before electricity gets anywhere, someone has to make it. And in India, no one does it at the scale NTPC does. NTPC is valued at around 3.85 lakh crore rupees. It accounts for roughly 25% of India's total electricity generation. One company generating a quarter of everything the country uses. That's a big number. Now, from an investor's perspective, what really stands out about NTPC isn't just how much it generates today, it's about what's coming next. The company already has 85 to 90 gigawatt of installed capacity, but on top of that, it has upwards of 20 gigawatt currently under construction. That's years of future revenue already being built. Very few companies in any sector can show you that kind of visibility. And within that pipeline, there's a clear shift happening toward renewables. NTPC has been steadily adding renewable capacity as part of its 60 gigawatt target by 2032. And this isn't just about going green, it's a practical decision. You're no longer exposed to the swings in imported fuel prices. Now, the business model is also designed in a way that makes earnings very predictable. NTPC earns a regulated return on equity of around 15.5% on its assets. So margins don't depend on where coal prices are next month. You pretty much know what you're going to earn. And then there's something quietly developing that most people haven't fully noticed yet. NTPC is starting to invest in green hydrogen and battery storage. Early stage, but it signals that this company is thinking beyond just generating power and positioning itself as a much broader energy company over time. But yes, there are risks to watch. The biggest risk is execution. Then project delays, especially in renewables, and any change in regulated returns could affect how quickly growth shows up in earnings. Other companies in this space which are worth knowing are Tata Power. It is basically pivoting steadily towards renewables and retail distribution. Then Adani Power, it is more of a thermal and merchant play. CESC, it is a stable distribution focused company. And JSW Energy, which is moving aggressively into renewables and storage. Okay. Now power has been generated, now it needs to travel, sometimes across thousands of kilometers from where it's made to where people actually need it. That's where layer number 2 comes in, transmission. And Power Grid Corporation is basically the highway system for electricity across India. Valued at nearly 3 lakh crore, it operates over 1,83,000 circuit kilometers of transmission lines and handles around 85% of all interstate power flow in the country. It also operates one of the largest synchronous grids in the world, meaning the entire country runs on one connected frequency network. Now here's what makes this business so interesting to own as an investor. Power Grid earns a regulated return on equity of around 17% on its asset. So it doesn't matter if power demand is high or low that month, the cash flows are predictable and steady. It's genuinely one of the most stable businesses in this entire sector. The order book right now is over 80,000 crore, largely driven by interstate transmission and renewable evacuation corridors. That last part is key as more solar and wind capacity gets added. That power needs to physically travel from remote location to cities, which means power grid's job becomes more important over time, not less. And one more thing worth noting is transmission and distribution losses across the system have come down from over 21% a decade ago to 17.52% today. The grid is getting more efficient, and that's a meaningful improvement. But yes, there are risks to watch: project execution and competitive intensity in new bids. If timelines slip or bids get too aggressive, returns can come under pressure. Now we have power being generated and a transmission network to carry it. But who actually builds all of this? The power plants, the transmission lines, the renewable parks, the industrial clusters. That's EPC companies, which is the third layer. EPC stands for Engineering, Procurement and Construction. These are the people who turn plans into actual physical projects on the ground. And here's a number to put the opportunity in perspective. Energy alone makes up nearly 24% of India's 111 lakh crore infrastructure pipeline. That's an enormous amount of physical work that needs to happen. L&T, roughly valued at 5.6 lakh crore, is right at the center of this. It works deeply in power transmission and distribution EPC along with broader infrastructure. When India's capex cycle is strong, L&T is one of the most direct ways to participate in it. The order book tells the whole story. Total orders currently stand at around 7.3 lakh crore, with infrastructure and energy contributing over 90% of that. And the near-term prospect pipeline, that's the work they are actively bidding for, is around 5.9 lakh crore. Order inflows are not going to slow down anytime soon. Margins are also gradually improving, EBITDA margins moving toward 10.4%. There are also growing international order component, which is a nice diversification because it reduces dependence on any single domestic cycle. But yes, there are risks to watch: execution, then cost overruns on large projects, especially in energy and hydrocarbon, and any slowdown in domestic government spending can directly hit margins. In EPC, the whole game is delivering on time and within budget. Okay, now let's move on to the next layer. This doesn't get talked about enough. Now think of all of this capacity being built. Power plants, transmission lines, renewable parks. All of this costs an absolutely enormous amount of money. And that money has to come from somewhere. Enter financing, which is the fourth layer. Power Finance Corporation and REC Limited. These two companies together fund the entire power ecosystem with a combined loan book already exceeding 11 lakh crore. And there's a big development here. The Union Budget 2026 announced their merger. The combined entity is expected to have a loan book exceeding 17 lakh crore. That's a massive, focused financial institution whose entire purpose is funding India's energy build-out. Between the two, PFC stands out for consistency. Loan book of 5.43 lakh crore, profit of 17,352 crore, and strong improving asset quality. REC, on the other hand, has a slightly different flavor: faster growth in renewable lending and strong disbursements backed by access to global capital. Something that's been quietly improving for both of them is asset quality. A lot of the bad loans from older, stressed power projects are getting resolved. As those clean up, capital gets freed up, returns improve, and they can lend more, which is a nice compounding effect. Risks, though, are real. State electricity distribution companies can be slow to pay, and that affects cash flows. Both companies also have high concentration in power, so any sector-wide stress hurts them. And as they expand into new areas, staying disciplined about who they lend to matters a lot. Alright, now power's been generated, transmitted, financed, and built. The final step is getting it to the actual end user. That's distribution, which is layer number 5. And honestly, distribution is where a lot of the mess in Indian power has historically lived. Most state-run distribution companies have struggled, financially stressed, and lost enormous amounts of power along the way. Which is exactly why Torrent Power, which sits at a valuation of around 82,000 crores, stands out. It operates in higher quality licensed distribution zones, which are areas where it can run efficiently and actually collect payments. And that has translated into steady, predictable cash flows over time. The company recently acquired a 1400 megawatt supercritical thermal plant from Nabha Power, which adds solid generation capacity and strengthens its baseload. And the structure of that plant is really well designed from a business standpoint. The entire capacity is under an availability-based tariff. That means Torrent gets paid for making the capacity available even if power isn't actually drawn. That takes a lot of revenue uncertainty off the table. Operationally, plant availability has stayed above 90%, and PLF levels, basically how efficiently the plant is running, have historically stayed above 80%. Those are genuinely strong numbers. Risks are there too: counterparty exposure and regulatory changes. Distribution is always one policy shift away from margin pressure, so that needs to be tracked too. Now, to other names worth knowing here are Tata Power, which has strong distribution presence in Mumbai and Delhi with meaningful efficiency improvements. And CESE is a more mature, stable utility which is predictable, steady, and has lower volatility. And now let's move on to the layer everyone's been talking about: renewable energy. But let me frame this slightly differently than you usually hear it. The shift to renewables isn't happening just because people want to be green, it's happening because fuel prices are unpredictable, and that is a real business risk. Think about it: crude swings, gas spikes, coal prices move with global demand. For any company planning a large manufacturing expansion or a new data center, not knowing what your electricity bill is going to be 5 years from now is a serious problem. Renewables solves that. You lock in a solar or wind power contract and you know your energy cost for the next 20 years. That certainty is what's driving businesses toward clean energy even beyond any environmental push. And top that with the structural demand coming from EVs, data centers, and a growing manufacturing base. The tailwind here is very real and very durable. The numbers back it up. Renewable generation has more than doubled in a decade. India has already crossed 50% non-fossil installed capacity ahead of its own 2030 target. The next milestone is 500 gigawatt of renewable capacity by 2030. Renewable energy credit inflows have also grown from 1,688 crore in 2021 to 10,325 crore in 2025, showing just how much the whole ecosystem around clean energy is maturing. The company to watch in this space includes Adani Green, valued at around 1,90,000 crore, 16.7 gigawatt of operational capacity today, targeting 50 gigawatt by 2030. The scale and ambition both are enormous. And then there is Suzlon Energy, which tells a very different story. A few years ago, this company was drowning in debt and looked like it might not survive. Today, it's moved to a net cash position, rebuilt its order book, and is generating strong profits. It's a genuine turnaround that's played out well. Okay, let's just bring all of this together quickly. 6 different layers, each connecting to the next. And all of it is being driven by the same underlying story. India needs a lot more power, it needs to be reliable, and increasingly, it needs to be clean. But here's the honest thing for investors. The easy phase of this sector is behind us. The time when you could just buy any power stock and make money because the whole sector was moving, that's over. From here, it's about execution. Companies that deliver projects on time, keep their balance sheets in shape, and turn their massive order books into actual earnings, those are the ones that will pull ahead. The sector is absolutely not over, but picking the right names within it matters a whole lot more now. If this gave you a clearer way to think about the power sector, that's exactly what we were going for. Like the video, share it with someone who's been trying to figure this space out, and subscribe for more such deep dives. Also, tell us in the comments which sector would you want us to break down next. See you then.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.